Welcome back to the final segment of this evening's edition of Your Money, Your Call. Hope you've enjoyed the program so far. Plenty of callers to get through before we reach the end of tonight's edition. Andrew, who's dialed in from Melbourne. Hi, Andrew.
Hi, thanks for taking my call. Just trying to find out about 10 Network. CanWest has sold his 50% at stake. I just would like to see is it worthwhile buying, or next one is CXY, please. Thank you.
Roger.
I can talk about that one. In fact, I was called by one of the brokers, or the broker to the deal, today, and offered shares at $1.30. The institutions are obviously getting an opportunity to buy at $1.30 rather than $1.37, which was the last traded price. Let me say this about Channel 10. I've got some data here going back to 1999. Its profits are slightly higher than where they were 10 years ago, which is not a great performance, is it, really? And what's interesting is the equity is rising for this business, as is the debt, and return on equity is about 12%, which is kind of it's an okay business. You know, it's not a great business. The sort of businesses that I like to own, they have returns on equity of 20, 25, 30%. This is really going to shock you. My valuation on this business is 49 cents. And because the return on...
currently sitting?
$1.37. Now, I seem like a lunatic saying that. I know that. You sort of think, how can the stock market be that wrong? But when ABC Learning Centres was trading at $8.80, I had a value of $2. You know, when Telstra was at $9, my value was less than $3. So these television stations in Australia have always had incredible prices or multiples put on them, unjustified by their economic performance. It's just these are the prices at which the moguls trade them. You know, they bear no relevance to the economic performance of these businesses, and so you know, I said no. When the broker called me this morning, I was actually walking across Darling Harbour, and I got the phone call, and you know, do you want to take some stock? I said, mate, I can tell you straight away, no thanks. You know, not interested, because the value is so much lower than the price, and that's because the economic performance of the business just isn't that great. And in fact, over the next couple of years, the valuation doesn't actually do anything. You know, the value doesn't rise, and you want to buy businesses whose valuation goes up over the next couple of years, and that doesn't seem to be happening for this business.
Nancy from Melbourne is our next caller. Hi, Nancy.
I would like to know what is the impact of, say, a rise in interest rate on one, the Aussie dollar, and two, stocks in general?
Yeah, well, it's a good generic question. So interest rates, of course, that's something, Roger, that we could be looking at sooner rather than later, depending on what the Reserve Bank, of course, decides to do there, or what banks decides to do anyway, regardless of what the RBA wants.
It's less important in the short term to worry about what the Reserve Bank of Australia is going to do, and it's more important to think about what interest rates might do over a 5 or 10 year investment time frame. And it's reasonable to assume that within that window interest rates would go up for some period of time. If that's the case, then much like gravity, which is an invisible force pulling us all down on Earth, higher interest rates is the invisible force that pulls valuations of assets down. So I'm constantly valuing businesses based on the business's performance, and also based on changes to 10-year bond rates. And if 10-year bond rates rise spectacularly, then what you're going to find is you're going to find that the values of companies will decline. So my answer to the question is higher interest rates is negative for all assets, for their values. And over long periods of time, if interest rates stayed high, well, funds flow out of stocks, out of property and into cash.
And just a few minutes left to go on the clock, but let's talk now to Shane from Melbourne. Hi, Shane.
Hi, well, I was wondering if the guys know much on the hybrids, in particular MXUPA, and whether or not I should continue to hold this one, or if they've got any other hybrids I should look at.
I own MXUPA. I bought it for the fund. The multiplex sites. I bought them for the fund that I used to, that I founded, owned, sold and ran. I'm not there anymore. I own it personally as well. The time to have bought it was, it got down to sort of the roughly $20 mark. It was actually a bit lower than that, it was a large position in the portfolio. The other one that I really like, though, is the Australand prefs. look, this particular space has really had a good run up now. I wouldn't be buying them here simply because I think that the bulk of the gains are made, but the yields are still good. I think the Australand, I'd prefer the Australands over the multiplexes in terms of quality and credit worthiness, if you like. But again, I've owned both and obviously done very well because the share price has done so well.
Gentlemen, we are out of time. Going to have to leave it there. Thank you, Roger Montgomery from rogermontgomery.com.
Thanks, Nina.
And Todd Kerslake from RBS Morgans. Much appreciated. Thank you both for your analysis and your expertise on tonight's program. To you, the viewers, thank you so much for all of your emails and to all of your calls. I'm sorry we couldn't get to all of you tonight, but of course we will be back next week with more shares editions of Your Money, Your Call. I'm Nina May. I'll see you next time.